The halving, certainly in a sentiment sense, can raise expectations. I think that overall liquidity is a much bigger impact on Bitcoin price during bull markets than the halving itself. Overall, the reason that those assets continue to surprise to the upside is because of that fiscal backdrop. If you were trying to short assets in an emerging market in a local currency, you're going to continually get headwinds from the fact that that currency is so weak, right? It's just that currency is going up in supply so quickly that the assets that you're denominating them in might not be doing great in real terms, but they're certainly doing fine in that local currency terms.
Alden emphasizes that overall liquidity has a more substantial impact on Bitcoin prices during bull markets than the halving events. While the halving reduces the daily supply of Bitcoin, the actual impact is relatively small compared to the potential inflows from ETFs or changes in net exchange volumes. Thus, external demand plays a more significant role in driving Bitcoin prices during bull markets. Alden explains that halvings are pivotal during bear markets, as they contribute to the long-term trend of higher highs and higher lows in each Bitcoin cycle. However, when it comes to the timing of bull markets, liquidity factors outweigh the effects of halvings. She adopts a 2-year view on Bitcoin, predicting that Bitcoin will likely perform well over the next couple of years despite potential periods of underperformance. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The halving, certainly in a sentiment sense, can raise expectations. I think that overall liquidity is a much bigger impact on Bitcoin price during bull markets than the halving itself, because if you do the math for how much supply the halving takes off the market per day, it's relatively small compared to what you can get from ETF inflows, or relatively small compared to what you can get in one-way kind of net exchange volume in a given day. And so the overall changes in external demand for Bitcoin play a bigger role than just the halvings during bull markets. I think where the halvings really matter the most is during bear markets. They play a pivotal role in why each cycle gets higher highs and higher lows than the one before it. But in terms of the timing of bull markets specifically, I generally point more toward liquidity and less so toward the halving, even though the halving is a very relevant kind of longer term factor. So for this year, I'm less certain. I prefer a 2-year view on Bitcoin. So I think that Bitcoin's likely going to do well over the next, call it 2 years. It can get through periods where it's overbought, right? Where you could have a pretty poor 3-month period with Bitcoin, and it could underperform almost everything. And then it could have another 3 to 6 months of spectacular gains. And so my view is generally looking back from late 2025, I'd be surprised if Bitcoin was not higher than it is now, notably, and that probably outperformed other kind of large cap things you can own. But you have to account for the volatility, and you have to kind of be prepared for that really uneven path to get there. What we're seeing is the denominator is going down more so than some of those assets are going up outside of the big bubble ones. And I would be concerned about some of the major stock indices because of how concentrated they are into some of the most expensive growth names. And so I expect the fundamentals of a lot of those growth names to probably do pretty well. It's just the question of how much you pay for them and how much of US household net worth is already stuffed into equities. So I do have concerns about them all continuing to rise together. But I think that overall, the reason that those assets continue to surprise to the upside is because of that fiscal backdrop. If you were trying to short assets in an emerging market in a local currency, you're going to continually get headwinds from the fact that that currency is so weak, right? It's just that currency is going up in supply so quickly that the assets that you're denominating them in might not be doing great in real terms, but they're certainly doing fine in that local currency terms. And, we're not anywhere near that level, but it's directionally a similar problem. When you have this kind of unrestrained fiscal spiral that's kind of just a slow motion background situation, that just changes how some of these assets are priced. And it doesn't mean you can buy things at any price, but it means that when in doubt, the answer is that scarce assets will go up in price relative to currency units. I generally think so. I think we've generally seen improving liquidity. A lot of it's fiscal driven, and so I do think that they've resisted the fact that yields are higher, right? So normally when you see yields, and especially real yields this high, you should see gold a lot lower than it is. And so I think that gold investors have been sniffing out some of those fiscal problems that I've been talking about. And in addition, because of decisions by central banks to diversify their reserve holdings and have more gold in their portfolios, that's been another huge factor as well. So especially from that foreign component, there's been a lot of demand. And so, Bitcoin's obviously had somewhat similar catalysts. It's heavily tied to liquidity. It's had catalysts from the ETFs and things like that as well. So the reasons that both of them are rising, I don't think are perfectly overlapping, but I do think that they are following liquidity, and which is largely a fiscal driven phenomenon. So I think that because we're now in this kind of fiscal dominance regime, higher interest rates fuel the deficit even more, which potentially fuels gold. I think you could get liquidity, like temporary liquidity shocks, if, for example, you run these big deficits, the Fed tries not to monetize them, and you get kind of like a temporary liquidity problem in treasury markets. That could certainly contribute to a gold sell-off temporarily. But I do think the breakout has legs to it. I think that the breakout is real. I think that it's based on fundamentals. I think that there's a good reason that a lot of foreign investors want to own gold more so than treasuries. And that they want to basically have a better ratio of gold to treasuries. And I think that that's probably going to be a longer term story. And I have no view on what gold does in, say, a 3-month period. But I do think it's now that it's broken out, I think that's a very strong sign that I think it's probably headed higher in the next few years.
Alden discusses the recent performance of gold, noting that despite higher real yields, gold has held up well due to several factors. One key factor is the diversification of central bank reserve holdings, with many central banks increasing their gold allocations. This demand, especially from foreign investors, has supported gold prices. Alden believes that the breakout in gold prices is real and based on strong fundamentals, projecting higher prices in the coming years. She contrasts the performance of gold and Bitcoin, noting that while both are influenced by liquidity, their catalysts are not perfectly overlapping. For gold, the fiscal backdrop and central bank diversification are major drivers, whereas for Bitcoin, liquidity and ETH developments play a significant role.
I'm bullish on Bitcoin, gold, energy. That's kind of the big areas of focus for me at this time. Bitcoin's already had a lot of powerful price action, obviously, earlier this year. So I think now it's consolidating a little bit. But over this year and next year, I'm bullish on all those assets that I mentioned. And of course, it depends on what their capital mandate is. So, energy is cheap and profitable and has good balance sheets generally. Gold and Bitcoin are kind of alternatives to treasury bonds or alternatives to tech stocks, for example. They can fit in a portfolio in that context. And so those are kind of the assets that I find attractive at the current time. Large cap growth equities have valuation concerns. So, for example, large profitable tech companies, even companies like Costco, for example, they're very highly priced relative to their fundamentals, relative to their growth. Basically, it's not a problem necessarily with the companies themselves. I mean, Costco is doing amazing. It's just that investors are really crowded and really kind of piling into them. So I do have valuation concerns for those. I don't really have valuation concerns for energy, for certain ends of the value spectrum, for some of these smaller companies, nor do I have valuation concerns for gold and Bitcoin. Instead, it's just a matter of that sometimes they can get euphorically overbought in the intermediate sense. So that's something I look out for. But other than that, I think that those areas are still not very crowded in terms of overall investor portfolio positioning. So I think you have to be sector specific. I think that's been the challenge. So over the past, call it 18 months, we've had a PMI, a Purchasing Managers Index, below 50 for like a year and a half. And so that's already been recession-like conditions for certain industries. And of course, commercial real estate's been in a depression-like context. Whereas some of the more service-oriented businesses out there, tech, there's other areas that have been in recovery mode. And so I think that some of that could rotate in the sense that some of the things that have been doing really, really well could increasingly show some weakness ahead. Whereas some of the things that have already gone through that down cycle, and if anything, I think some of them are recovering. I expect probably higher PMIs by the end of this year than we started the year at. And I think some of those more cyclical things could follow that. So I think that question of slowdown versus not slowdown is very sector specific. I think instead it's more of a rotation, a reacceleration of some of those things, even as some of those bigger tech things do slow down. So I do, but I think that even some of the action we've seen is indicative of not super bullish sentiment. People don't pile into Costco at 50 times earnings necessarily purely out of bullishness. Some of that is because it's actually a form of defensiveness. It's saying, I don't really want to own bonds per se. I want to buy a really blue chip company, and I'll crowd into that rather than owning any of the things that are more cyclical. The energy names, the banks, that's the capital flight out of there, I think, has been indicative of risk off behavior. And so I don't view that the current period we've been in as super risk on. And instead, it's more indicative of fiscal dominance, indicative of how many other areas are perceived as non-investable. And I think what we could see is a broadening out of what is perceived as investable, right? So some of the risk sentiment could actually increase for some of the things that have been considered too risky, whereas some of those things that people crowded into, I think people could get quite concerned with the level of valuation there relative to the growth numbers that are coming in. We've seen, for example, Apple and Tesla just not putting up amazing numbers, and the problem is that investors had overpaid for relatively spectacular results that they're not getting in the fundamental data.
Alden expresses her bullish outlook on Bitcoin, gold, and energy, considering them attractive investments in the current environment. She points out that large cap growth equities, although profitable, are overvalued relative to their fundamentals. In contrast, energy stocks are undervalued with strong balance sheets, making them a compelling investment. She also touches on the cyclicality of different sectors, noting that certain industries, like commercial real estate, have faced recession-like conditions, while others, like tech, have been in recovery mode. Alden expects a rotation where sectors that have underperformed may start to recover, while those that have been performing well may face headwinds. Please like and subscribe my channel.